Asset management skill can be found in dedicated asset management businesses, life insurers, and in some instances, banks. Though through time, different reasons drove ownership of asset managers, and varying levels of skill can often be ascertained by looking at the cross-section of managers available. But what does the future of the industry look like? What are some of the main drivers for the change? Gentlemen, welcome to the program. Thank you so much for being here. Kirby, let's kick off with you. And where are we sitting right now? I know off air we're talking about the three different phases. We've got diversified structures, dedicated managers, and then you've also got divestitures with regards to something that occurs after a credit crisis. Where do we stand right now?
I mean, let's just start quickly. The two authors of the book, actually, there's a synopsis of this book in the Financial Analyst Journal, and the one that came out late last year. And it's called Most Likely to Succeed, Leadership in the Fund Industry. And they talk about these three different kind of subsets to how people kind of either acquire or kind of get rid of asset managers, and this is on a global basis. So the first one is in 1993.
And that's got to do with cycles, obviously.
Yeah, absolutely. I mean, the one was in 1993-2001, where diversified firms were seen as buyers of asset managers. And in this case, these are banks and life insurers which start acquiring kind of asset managers. They start acquiring asset managers because they think there's going to be they'll be able to create earnings out of these. The second period was 2002 to 2006, where dedicated firms actually became buyers of asset managers. And this is where dedicated asset managers look at how they could potentially buy some other asset managers. A great example of this was BlackRock, which bought Merrill Lynch, the asset management business, during that period. And in 2007 and 2010, this was what they call credit crisis divestitures. And that, in essence, is the credit crisis happening. You've got to run on your capital, and you now need to start getting rid of some assets because you just can't keep the ship afloat anymore. Great examples of those being AIG and Bank of America that had to start getting rid of some of their asset management businesses. And those are distressed sales, for asset management at the end of the day. They're not necessarily a sale that happens at a very high valuation, but it nevertheless happens. And the question is, from this point forward, what actually happens in asset management, and is there maybe a correct format as far as asset management is concerned from a structural perspective?
Do you think that there is a correct format? Because a lot of asset managers are perhaps diversified, do you think, and not really have one specific philosophy but embody many. Is this a good strategy to have?
I personally wouldn't want to be working in an asset management firm owned by a bank at the moment, especially in Europe. I think a lot of these, also regulation is forcing the banks to restructure their entire business model. I think in South Africa we're much more isolated from those effects. But generally what you find is fund size is often a determinant of what kind of business model you have. So you start off as a boutique kind of small firm with a few guys getting together, and as the firm grows, their business model has to change because their fund size actually makes it harder for them to deliver outperformance, although it's very good business from an earnings perspective because their revenue depends on how much money they're managing. So as they get bigger and bigger and bigger, what happens is you start seeing them breaking themselves internally up into smaller teams, these kind of internal boutique structures. And we can discuss that maybe a bit later on, but the focus then is also quite important, is how independent are these boutiques? Because if the boutiques are dominated by a house view, in other words, what the economist and the strategist says, and all the portfolios across all the boutiques have to sort of take the RAND forecast and these things into account, it creates again a sort of mediocrity and a kind of a groupthink problem. Whereas if they truly are independent boutiques, then you have a better kind of large asset management business model. So I think fund size is actually a
determinant of whether
a major business model determinant.
Yeah. Kirby, in your eyes, who wins at the end of the day? Those that are dedicated or a large organization that becomes diversified in its philosophy and thinking?
I absolutely love dedicated asset managers, and I think that boutique asset managers can deliver long-term sustainable returns. But and I come back to what Roland said just now, there's a cusping point as far as dedicated asset managers are concerned, because at what point do you start saying fund size is becoming too big? And there's tons of research has been done about this on a global scale to kind of look at kind of the adequate fund size.
So what do you say? No to new money because we need to stay boutique?
Well, and there are asset managers, and there are asset managers that do it, and you've got to take your hat off to them. You see, asset management actually, Eleni, is actually quite a boring business. Let me tell you why. There's two ways.
Here, right?
There's two ways you can drive earnings. The one is the market going up. That's the one way you can drive earnings. Or alternatively, you've got to write more business. You've got to get more funds under management. Just have a look at your screen quickly. There you'll see the large economic cycle, and you see its distinct 5 phases of the large economic cycle. The red stage there is the bear market. You can see where that's right at the end, and that's kind of where the whole world kind of contracts, or where countries contract. And then you've got a bottoming out phase, an early stage recovery, and probably a mid-stage bull market, and then the peak of the bull market. Now, it's generally where diversified firms would buy actual asset managers is what we call a mid-stage bull market or the peak of the bull market. Why? Because the markets are doing so fantastically well that they think they can meaningfully add to their bottom line earnings by adding an asset management business to their total mix, so to speak.
So that's the wrong stage of the cycle, essentially.
Correct.
If you want to make.
If you're a dedicated asset manager, you might be very keen to actually buy an asset manager at the bottom out phase or during a bear market. And that's, I mean, the credit crisis was a classic example where guys were giving up asset managers at very, very good and favorable rates. And that's where an asset manager might be very interested in actually acquiring back some asset management skill because you know, quite frankly, it's trading at a very good price.
Exactly, so quite a bit of value to be offered. And then the psychology, if I could just say, it says fear, panic, and loathing on that table.
Yeah, don't you like that? That's good from a market perspective, not from a sell-side perspective, though.
Kirby mentioned that asset management is a boring industry, but I think it's also quite a difficult industry because it's sort of schizophrenic in a way, because you've got two people you've got to please, and trying to please everyone is never a good idea, but you've got your shareholders and you've got your clients. And trying to please both of them is actually in a way diametrically opposed, because pleasing your shareholders means you've got to grow your assets, which immediately puts pressure on you to deliver outperformance, which means your clients might not benefit as much as your shareholders. So where do you draw the line there? And you mentioned there is research on measuring fund size. We actually did this, this is a while ago, probably 5, 6, 7 years ago, but we actually measured that between 5 and 8 billion rand in those days, you could not add as much value anymore as just the general market. So even if you had skill, and this is an important thing, it's not a skill thing. Fund size drowns out the skill to such an extent that you become a closet index fund. So that is a definite limit where you start seeing the skill petering out.
Out of interest, Roland, where do you think we are with regards to the cycle? Early stage recovery, would you say, or
well, I mean, after the 2008 bear market, I would imagine that markets in the next 5 to 10 years will be higher than they are now. So I would think that we are in a new upward swing in the markets, which is good for asset managers' earnings, but they obviously have to outperform the market. They're not there to track the market.
Yeah, I mean, I'd agree. Early stage recovery. I mean, just look at the emotions there again on your screen for early stage recovery.
Doubt, reflection, and conversion.
Doubt, reflection, and conversion. As a matter of fact, I thought we actually saw some of this, what we call a mid-stage bull market,
there's a lot of
starting
reflection
to happen
going on
in the beginning of 2010. Some faith, hope, and charity, and that dissipated completely in 2011. You know, we're back to doubt, reflection, and conversion. Are we going to recover? Aren't we? Are we going to default? Aren't we going to default? You know, that happens on a global scale.
But surely, I mean, we can keep repeating the cycle. I mean, when you look at the peak of the bull market, euphoria, greed, and extrapolation, do you think that we'll ever learn from all the cycles that eventually it does go down? No?
I think you're sort of forced to be part of the cycle, because what do you do if there's a bear market and you're losing earnings? You're sort of living the consequences of a strong economy previously, and then there has to be some recovery.
So what's interesting also, the internet has quite a bit of say with regards to the trends.
Yeah, I mean, the interesting thing is, I mean, while I was a student, I, with interest, looked at how Citibank was growing. And remember, Roland, how they bought Citi, how Citi bought Travelers, and then just continued just to add kind of businesses around this kind of mega bank, just with various amounts of financial services that they were trying to give to one client. And they found, and it wasn't just them, but most of these kind of very diversified firms found out a couple of things. Firstly, clients buy performance and buy skill from asset managers. And if you in a massively diversified firm where maybe you're utilizing them from a banking or an insurance perspective, you're not necessarily going to use them from an asset management perspective. People from an asset management perspective potentially maybe want some dedicated people looking after their money and kind of focusing on their capital.
But are you saying cross-selling doesn't work? Because that's why they did this diversification, because they wanted to sell to their clients
and
in addition to asset management, all the other kind of...
Pozen and Theresa Hamacher in this specific book looks at cross-selling and saying that cross-selling, actually they found that cross-selling actually didn't work well at all. And I'd probably say that that's potentially right. If I look at South Africa and I look at many of our financial services organizations, you use dedicated people for insurance. You're not necessarily going to buy an investment product from them. You might, but you might not do so.
Well, the bank assurance was the whole thing. You know, you've got your banking clients and then trying to sell them insurance.
I think the toughest thing from a bank assurance model perspective during those times was the fact that we were sitting in these kind of early stage and mid stage recoveries, and we were heading into the peak of a bull market. And when from an insurance or from a big conglomerate perspective, you're looking at the earnings that an asset manager can generate, you're kind of sitting and saying, well, there's incrementally always more earnings here, which is fantastic. But invariably, when there's a bear market, which invariably will always happen at some point, then you've got less earnings out of it. How do you cater from a corporate perspective for something like that? And does that influence investment decision making at the end of the day?
What's also quite fascinating, Roland, and I remember during the crisis that a lot of the articles that were coming through were saying that asset managers were losing money, and it seemed that most investors were opting to go the alternative route, something that is low cost. Does that then fall into divestitures with regards to after a credit crisis? So in other words, we start seeing the investment community moving towards alternative investment structures.
I think the credit crisis and the divestitures in terms of firms from that consequence was actually much more of a regulation kind of concept, because a lot of firms were taking risk, or banks were taking risk in all sorts of areas that compounded the risk. So there was leverage in the system. And what the regulator said is you've got to break up these businesses, these too big to fail businesses, because they were so integrally involved in everything. So what caused those divestitures wasn't a profitability argument or a return argument or a skill argument from the asset manager. It was actually the regulator saying you cannot have hedge funds, you've got to not just service corporate clients, you've got to have retail clients, you've got to break up the business model, and that's driven a lot of this change in the industry.
Yeah, and a good buying opportunity, for some of the dedicated asset managers who just want to go and sit and look after money. I respect an asset manager who closes a fund, who says, look, you know what, we can't actually generate returns if we grow this thing beyond this point, so we're going to close this fund and we're going to allow ourselves some room to breathe here and actually manage money, because that's what we do. That means they're putting a client ahead of the profit motive. And that's part of the reason why, if you're an asset manager and you're in the listed space, or you're listed as a business, who do you put first? Do you put your client first, which is the unit holder or the investor, or do you put the shareholder first? From
an investor perspective, I'm hearing this. So you're saying that I should go for a boutique asset manager that is not listed, that would be catering for my needs and would take the hard decisions with regards to closing a fund should it need to happen.
John Bogle always said you should never invest in an asset manager that's listed, because the shareholder's interest will always come before the client's interest. That was his view.
What is your view?
I would agree with that, but I would look at the fund size. I mean, if the asset manager is very big and has got one house view, they're going to swing with, as the market swings, in terms of they're going to outperform and underperform, and they're basically going to give you pretty much the return of the market in the long run. However, if it is a large asset manager that's got dedicated teams that do not talk to each other, that are not influenced with groupthink, then I think you can cherry pick within the asset manager certain funds.
Yeah. And for you, Kobe, what about compensation for asset managers?
Look at it this way. Dedicated firms generally compensate asset managers far better than diversified firms. From a diversified firm perspective, they've got a diversified business they're trying to run. Maybe they're in insurance, they want to be in asset management, and they want to be in various other services as well. So people get compensated well, but not to the degree that if you're actually in a private business. The other thing that's nice about a private business is that asset managers own them. And asset managers own them, and they make decisions based upon their own capital that's invested in the business and potentially in funds, and then by virtue of that actually make the right decisions for their clients as well. And that's why, for me, from a boutique perspective, you're going to see the rise again of the boutique business at some point. Some of the large, let me be fair to the large diversified businesses, and especially here in South Africa, we've seen large diversified businesses coming to the foreground and saying, look, we need to take cognizance of this. And some of them have actually gone and created boutique houses within a larger conglomerate's kind of size. So we've got smaller teams operating in dedicated smaller businesses, and they service their clients, but it might be owned by a larger conglomerate.
Okay, so let's wrap up this conversation. Where do you see things going here in South Africa? You were alluding to this. Do you think that that is going to be a stronger trend in 2012?
Well, I'm going to wrap up by looking at the chart quickly on your screen over there. This shows you the top 10 asset managers in the US, and it shows you from 1990 2000 and 2010, and it shows you who the largest asset managers are. The ones in bold are the dedicated asset managers, and the ones that are not in bold are kind of the more diversified firms. There are exceptions to the rule over here, but if you have a look at it over time, there are far more dedicated asset managers that kind of are starting to manage more and more the capital in the American situation, and I expect potentially the same to start happening elsewhere, not only here but also in emerging markets.
And Roland, for you?
I would, from an investor's perspective, want focus. And if it's a large firm, I would be more worried than if it was a smaller firm. But you've got to look at the investment process that the asset manager is following. Is this asset manager independent, externally or internally in the firm? The more independence, the more focus, and the more
attractive it should be for investors.
The more attractive it is from my perspective to put money with somebody who's looking after my money only, rather than doing all sorts of other things during the day as well.